Welcome to the ProVest Pulse. I'm Gabe, he's Noel, and guys, I'm excited to get into the week. What a calm week in the markets that we just had. I'm just joking. It was quite a ride. Tons of cool data we're going to get to. We're working on things that we can do to make that happen as a company, because a lot of what my portfolio and my modeling is based on is certain securities that I need to keep people up to date about. So we're working on figuring out how to get that in place for us in the future. So for right now, we're going to stick to broad market sentiment and broad ideas on where things are trending.
Basically, our company thoughts on the what's happening in the markets and what's happening in the world.
Yep. So I'm excited. Tons of cool data. First thing I want to do from now on is I'm going to talk about family a little bit, but quick little key points. I want to go over what we're going over. The sell-off, obviously, we all know what was going on with Iran. So that was a big question that was on top of a lot of our clients' minds going into the start of this week, and especially the first couple of weeks in April. So we're going to be talking a little bit about that and where we are now. The data behind the drop, there's a lot of opinions that I will share on what I believe that was conducive of. Opinion follows trend. So keep that in mind when we're talking about it. And then the economic foundation, we're going to talk a little bit about data around the economy and what comes next, where we're seeing stuff. But first of all, family first. I'd love to talk a little bit about what's going on with my life. And Noel, if you want to chime in on what's going on in yours, feel free. But I am officially now a uncle. As crazy as it sounds, my younger brother beat me to the punch. He had his first kid, and now me and my fiance have to play catch up. But meet Maxwell Julian Lopez. It's a beautiful boy, and it's exciting to see. I need to get time to visit him out in Texas and introduce myself to my new nephew. But it's great. You can see my mom and my little brother Jesse holding Max. It's my other brothers and his girlfriend, my dad. Just a bunch of pictures. It's great. It's a little weird to be an uncle now. You know, a lot of kids in my generation will, if you hear somebody call you Unc, that's now I can be called that. I'm now an older person. So it's,
well, this has always been a family oriented company and practice. And my son was raised in it. He is now 37 years old and out in California and doing his own thing. And I've got grandchildren, and they're grown, and one of my grandchildren has a child of her own. So we keep populating the world.
Yep. And especially with being the oldest of the family of 7, we're going to be spreading the Lopez name around. So I'm excited for that. And Max is the first of many in the Lopez generation. But anyways, just wanted to give everybody an up to date. It's cool. It's beyond, I'm happy to see that happening. Let's get to the fun stuff. Data. What happened in the market? We all know geopolitical tensions were going on. That kind of sparked a big sell-off, especially early in April. It was very eerily similar to what we saw with the tariffs. So, and I'll get a little bit to that in a second. S&P 500 repriced very quickly from forward PEs from 23 to 19. I think a lot of the conversations that we had last year with clients was the S&P 500 was vastly overvalued, and right now it's getting back to the very viable valuation. So that's something we're keeping an eye on and where that's heading. You can, on the graph over here, you can see the plays throughout the years and where it is currently. Very similar to what we saw with the tariff boom. Fear. Obviously, everybody was very, very scared on the let's call it uncertainty with the big man tweets and where the war was heading with Iran. And so what I'll talk a little bit about that fear is put buying, retail and institutional put buying, which is essentially, for those who don't know, buying puts on the market is essentially like buying insurance on the market itself. You're buying a contract with somebody saying that if the market goes down, you'll pay me money, but that costs money if it goes up. So record put buying, that was something that was caught me off guard, because at the end of the day, this echoes what we saw last year, and I'll talk a little bit about that as well. Retail investors sold a lot at lows, and I've had a conversation with my dad, who oversees a lot of who sees bigger institutional firms, and a lot of those financial advisors took their clients out of the market into cash, and I talk about the worst time to do that. I mean, everything was gearing up for a rip your face off rally especially with all the record put buying where the fundamentals of the economy was going. It's a little bit sad to see some of these financial advisors react to the herd and not think for themselves. And that's something that is concerning to say the least. And I'll talk more about that. Energy markets, if you guys have any energy exposure, you can definitely tell what's going on. The second graph that you see is the Strait of Hormuz vessel crossings. As soon as you saw that numbers were going up, especially in terms of crossings, you'll see the energy sector start to get back to being priced in. And so keeping an eye on those graphs and where that's going, it's a sharp decline, then you get to see a little bit about where it's trending towards now. So as soon as you start to see ships coming through, you'll get to see the returns on what the market sees that as. Some key data points I want to go over. Like I said, S&P forward PE is now back into some valuations that are attractive. Again, the put to call ratio really, really surprised me. I mean, talk about the worst time to buy insurance. People were buying insurance on a house that was already on fire. And that was, there's a lot of things to be commented about that. But what I see in markets and what I've learned through a bunch of intelligent people who've come before me is you want to be selling on strength and you want to be buying on fear. And the fear that goes into the fear and greed index we saw earlier in April. I don't think I got a chance to talk about this in episode 1, but the fear and greed index got down to 10. And 10 is about the lowest it got during COVID. So technically, more people were about as scared from when COVID started, which when COVID started, we didn't know if we'd get a vaccine. We didn't know if we'd open back up, to where we
didn't know if we're all going to die.
Yeah. So
to be honest with you, now, Gabe, tell the viewer what that 28 means.
28 means we're on the very end of, or we're near the very end of the ticker. I'll put in a picture for the fear and greed index for next episode so you guys can get an idea of where that's heading. But the ticker goes from 0 to 100 and it's distributed by CNN. It gives you a bigger outlook on how consumers and the consumer sentiment is on the market.
There's more fear in the market than there is greed right now.
Way more fear than greed. So that gives you an indication of where the general population is feeling. But always good for me, especially if the companies that I'm looking at are higher in intrinsic value and I can buy them even more at a discount. I'll tell you, we covered this in episode 1, but Wall Street is the only place where they will have a clearance sale and people will run out of the store instead of running in. I got sisters, they're big into the clothing brands, and I promise you if they had those clothing brands on clearance, they would be in there for God knows how long, and God help my father for that check that comes due. But that's something to keep an eye about. We're in deep fear territory and we're starting to see a slight rebound, especially after the talks that they're having and the peace deal. We'll see where that goes. That could change tomorrow after we're done filming this episode. We're filming this on April 10th. So we're keeping an eye on that as well. Quick little quote of the week. Look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. From the master himself, Warren Buffett. It's something that I've really built my model off of. You got to be careful when you're following everybody else and you're listening to these sell side analysts downgrade stocks where everybody thinks it's going to be the worst time on earth. I'll tell you what, the end of the world only comes once. And if it does come, you'll be worried about much bigger things than your investment account. So until then, let's focus on things that we do need to focus on. And so that's the mindset we like to have. And that's the mindset we like to keep here. Noel, we talked a little bit about the coiled spring, that you called it the coiled spring, on how we see the market and where that was going based on the record put buying. I mean, insurance was being bought by a bunch of different people. You see them, you'll have a quick little graph here. It shows the S&P price movements and where the put volume was. So as you'll see the put volume.
Just saying when people are buying puts in the extreme, that is a really, really good time to be actually buying the stock. That's the time to be buying the stocks themselves, because it seems like every time people are really, really scared of what the stock market is going to do, and they buy these puts, in large measure, what happens is the market just seems to go up from there. And so that looks to me like a very, very good buying opportunity, and we've used it as such.
Right. Because, and if you look at the dips in the SPY, the broad 500 market index, compared to the put volume, you'll see exactly what happened after puts were bought. So will this mirror what we've seen in other put buying opportunities? We'll see. We've made a suggestion on where that could be, or an opinion on where that could be. The past doesn't always indicate the future, but we're keeping an eye on that, and we've looked at trends and where that goes. But that level of fear, measured and documented, has historically marked some of the best buying opportunities of a generation. We had seen some same extreme positioning at the COVID lows and before, during the great financial crisis. That goes a little bit beyond the graph that we've shown here, but you'll see something very similar in the future. The asymmetry was clear: limited additional downside if conditions worsen slightly, and significant upside if resolution emerged. The market was a coiled spring, and the conditions were right to be a buyer, not a seller. So that was something I was personally very happy about with the model that I run. And so if you're the person in my model and you're looking at your account, you're smiling, you could eat a whole watermelon. So always good things. Extreme sentiment, rare signals, what we're watching. So again, I'll harken on this again real quick. Record options activity seen around COVID. Retail investors selling at the bottom. Even institutional investors were selling at the bottom. Hedge funds were mostly short, have been way shorter than they've been in years. And when short covering begins, it dramatically accelerates any rally, adding fuel to the recovery. Because if you do buy a short, you are expected to buy back that short at some designated price in the future. And if the market gets higher, you're going to sell back at a higher price. So if they get this wrong, and it's looking like they're getting it wrong, they can really ramp up the rally that we might see. And we've seen in the last couple of days, just by a quick tweet on, don't worry guys, we got everything handled. Iran is going all right. Corporate insiders were buying. The percentage of corporate officers who were net buyers of their own company stock hit levels typically seen only at major market lows. And based on history, they have the best information. If you're keeping an eye on CEOs and where they are allocating their money, that gives you an idea of how they see their company and how they're viewing the general output. You do want to ask the question is if they're selling their stock on a liquidity event, maybe they're buying their 17th home somewhere, or they're putting their couple kids through Harvard. You need to keep an eye on why they're selling their stock. But if a lot of them are buying, which we're seeing, something to keep a note about.
Mm-hmm.
Quick little economic data points we want to go over that we see as really important. Household debt to service ratio. So back in 2007, near the financial crisis, we saw a 15.8 debt to service ratio. Currently, we're at 11.6. So tells us and indicates to us that the American's consumer balance sheet is in solid shape. Obviously, things could be better. And that's the one thing I hear from a lot of people is they wish things were cheaper at the grocery store and the gas pump. Hopefully, we'll get to those points again. But from what we can tell, balance sheets are still healthy for a lot of people.
I really don't think that it's going to get cheaper, but just hopefully we have more money to buy what we need to buy with.
Right. Let's hope
things become more affordable because we have more.
Mm-hmm. Absolutely. And income tax refunds year over year, 14% year over year increase in tax returns. It's funny. I had a call with my fiance last night, and she told me her tax refund and well above what I got. And she didn't know really what to do with it, and talked to me about what she would want to do with it and what she could do with it. So I bet a lot of families are feeling the same thing. If you put in overtime, you get that tax deduction, you get that tax credit, better tax opportunities there. So we're keeping an eye on where that tax money could go to, or that tax refund money could go to. Consumer sentiment is still at the lowest it's ever been. People think that everything is not going great. So consumer sentiment's at a low, but we still are getting money in our pockets. 15% Q1 earnings growth and the consensus. I'll show a graph on this a little bit later, but lot of equity holdings for institutional buyers at 50%. That's the consensus of where earnings are going for these companies. A lot of people are worried about the CapEx spending on AI, but a lot of what we're seeing in terms of earnings and a lot of these companies other than the Mag 7, their earnings are still very strong. We're seeing very historical high estimates on where that's going, and that's only comparable to recoveries from major recessions. So these are numbers that have really surprised us that we're keeping an eye on. 2026 S&P earnings per share revisions were up 4%. Earnings estimates were revised upward 4% since January 1st, even through the conflict. So even though war was going on, companies were still making money. Things were still going fantastic. Reshoring, spending, and consumer themes that matter. So manufacturing is expanding. Manufacturing continues to grow and reshore, and the reshoring of American production is real and accelerating. Factory owners report full order books as far as the eye can see. This isn't just the temporary blip that you might have beforehand. So people are buying stuff. Factories are getting their order sheets and they're feeling fantastic. Consumers keep spending. Retail sales beat expectations. Consumer spending rose $32 billion in 1 month, led by motor vehicles and parts. So a lot of people are spending on cars. That's a section that I wish I could talk about on where my model is, but can't talk about that. The American consumer did not disappear during the uncertainty. While people are a little bit uncertain, they're not going anywhere. They're still spending money. Bank lending is picking up. Commercial banks' loans are rising, a sign that credit is flowing and economic activity is expanding, not contracting. This is an early but important signal of economic health. Consumer confidence is turning. Confidence has been coming off the mat, which has historically, when this indicator reverses, markets respond with strength. We saw similar turning points in the early 1980s, 1990s, and post-Great Recession. So I'll show the graph right here. When you hit 08 and you hit that consumer sentiment, we're actually lower in consumer sentiment than we are in 08. So people are feeling more of a burden today than they were back when the Great Recession. I think that's a little bit overdone. So we're seeing a little bit of a rebound here. And once we get that rebound, you are going to see a rip your face off rally that will put you in a great circumstance if you were a buyer in fear. Now, you don't want to be buying when everybody else is now hopping on that bandwagon. You want to be buying when everybody else is selling their shares at a discount. But these are things that we're keeping an eye on because consumer sentiment, once that rips up, you will see a bunch of different consumer sentiment. You'll see the consumer sentiment sector rip up and a bunch of stocks accordingly go that way. So we were near 2022 in terms of consumer sentiment. 2020, you saw that big dip.
Even me that the sentiment is lower today than it was when we were having the recession in 2008 and the market was going down so much.
Well, yeah. And we talk a lot about emotion on our radio show and our podcast, Noel. A lot of emotions play into investing for a lot of people, individual people, their 401k, their even financial advisors. Talking to my dad, even financial advisors are falling for this trick. So you have to be careful on how you're feeling and what you'd like to do on that feeling. It matters a lot on data and having somebody that has a strong iron will on where things will go in the future. So anyways, just wanted to show that chart. Found it very, very interesting. Again, we're going to hit on the fact that the market is telling a different story, or the economy is telling us a different story than the market is. When you look underneath the surface at balance sheets, earning estimates, and the labor market, the picture is very different from what the headlines suggest. And we've talked a little bit about this in one of our earlier radio shows. The media loves to put bad headlines first. It doesn't matter if, company X, Y, or Z had record-breaking earnings and this is the sign of consumer growth. If one bad story will generate more clicks and more views for their radio station, they're going to put it up. And I guarantee you that goes from whatever side of the aisle you're on. So keep an eye on what they're feeding you and what the data is showing. So I like to keep an eye on both ends of the spectrum and see what's the middle ground there. So earnings estimates for the S&P 500 were revised up 4%. since January 1st in the middle of the geopolitical conflict. So even during uncertain times, companies are making more money, more earnings are coming in. Stocks should be following these earnings, but as you can see in the graph, equity positioning just meaning retail buyers, institutional buyers buying equities, is much lower than what the consensus should be showing. So something to keep in mind. S&P 500 earnings per share growth going up, but people are selling. Why? Opinion follows trend, ladies and gentlemen. Opinion follows trend. So the consumer kept spending, manufacturing kept expanding, and the corporate insiders kept buying their own stock. That combination told us everything we needed to know where the real fundamentals stood at the end of the day. We want to talk really briefly on the Iranian conflict and what that has done in the past. So markets have historically bottomed really fast during conflicts. I really like this graph from FundStrat that they put out. If you take all the months during any of the wars, if you take all the percentages that went down during all the wars, and if you average them out, if you median them out, markets bottom within their first 10% of the war. So, research going back to World War I shows that markets have typically bottomed within the first 10% of the conflict's duration. History favored patience and presence, not panic selling, ladies and gentlemen. So if you have somebody that's telling you to get into cash, maybe they should be listening to our podcast.
I can tell you that most of the people that I've had people that call me and want to take the money out of their investments when a conflict starts, and they get in that and they hear all the bad news. They say, "Oh, I'm going to lose all the money," and they take their money out. The only problem is most people don't know when to get back in, and so it's better if they let us do that, because we have signals that tell us when the best time to get out is. And usually it's not at the beginning of a conflict. Usually it's when we have actually bad economic news, and politics have very, very little to do with what's going on economically.
Yeah, because at the end of the day, we want to be data-driven. We want to be forward-looking, not emotionally reactive. So that's what we're here for, and that's what we're here for you guys for at the end of the day. Extreme VIX predicts strong returns. VIX, just the volatility index on where the market's doing. When the VIX spikes to levels seen during the sell-off, forward 12 months returns have historically averaged 20 to 25% or more, according to market data. So these big sell-offs, I'll say it again, buying opportunity, folks. Sell into strength, buy into fear. Strait of Hormuz, a real-time signal. Non-Iranian oil tankers crossing the strait again for the first time since the ceasefire is a meaningful early indicator that conditions are normalizing. Something that we wanted to bring up, because with the big man in the office for 3 more years, we want to give you an idea of the data on what the market has done while he was in office. Quick little post that I really, really liked from the Almanac Trader. If you want to follow him on Twitter or X, this is something that really interests me that I wanted to share with our clients and our audience. The green line, Trump presidency years. This takes into account 2017, 18, 19, 20, and 2025. So all 5 years, what the S&P did, that is what it averaged out to during his presidency. And the red line is just 2026 alone. Based on what we saw.
Seems to be tracking pretty close, doesn't it?
It does seem to be pretty tracking. So what does that mean in the future? We can only make assumptions, but they are good ones. Historical patterns during Trump's presidency show consistent weakness in April. We saw this last year. Many of you folks were with us during that whole whipsaw and what we saw there. But we've been tracking this very carefully. The April sell-off fits the seasonal script, and the subsequent recovery rally also aligns with what history suggests should follow. Seasonal patterns support continued market strength through the second half of 2026. We might see some volatility in October with the election, but we'll see on, we'll keep an eye on that, but that's in a little bit of the future. We're expecting some volatility during that time frame. Key point to watch, like I said, October election, a little bit more volatility, followed by typical end of the year recovery move. Where do we go from here? Noel, this is something that I think you wanted to talk a little bit about distinctly.
Yeah, if you take a look at where we are right now and where we want to go, we're looking at potential today as we record this. The S&P 500 is in the 6,800 range. So we're looking at the S&P 500 potentially pushing a little over 7,000, could be up as much as 7,300 short term. I mean, sometime this year or earlier this year. Midterm, we expect there to be choppiness in the markets because, well, there usually is. We've got an election this year, and there's no reason to panic if the market goes up some or down some based on what people think that's going to happen with the election coming up in November. And in fact, it may represent the ability or the opportunity to buy at better prices. And then long term, as far as just the secular market, we've got some really, really good tailwinds. We've got the manufacturing coming back to America. We've got the housing demographics of young people getting into their prime house buying years. My word, what AI is going to do, I don't even think the people that work with AI know what all it can do yet. So all of those good things remain fully intact. And but you're going to hear short-term noise if you turn on the news, no matter what channel you turn it to, no matter whether they're a conservative channel or a liberal channel. There's still going to be a lot of noise, and they're going to be telling you the news from their perspective. It's usually not something from the middle. It's going to be something from either side. So if you want to have something that's more balanced, I would say listen to one channel, a conservative channel, then listen to a liberal channel, and sort of put everything somewhere in the middle. But that's what I think is going to happen. I think we've got some really, really good times that we're getting ready to have.
Yep. At the end of the day, we're looking at the long term. The short term does not affect our long-term strategy. We look at fundamentals. If you're in a model that I'm finishing up building and I have a couple people in currently, that time horizon is 2 to 3 years. We don't care what the short term is telling us. We've built out a thesis. We know where things are heading. We know the strength that these companies have. We know the strength that the market has, and we're going to be continuing in that direction. So no matter if it really hurts to hear a lot of advisors moving people into cash and during times like this, but this is when you should be having some of those cash that you withdraw during the highs and start buying during these times, because that's how you supercharge your growth. But I digress. So we started this recovery from position of strength with more in our positions in the hole, buying more in the holes than before them. And that just depends on what model you're in. I know if you're in some of our conservative models, you've have not been in equities either way. Some of our models are much more reactive. So some of our models got out a little bit, not a whole lot, but certain models actually bought in more. So depending on what you're in, might be a good question to ask me and Noel on where you're standing and how that worked out. What we're watching, very, very, very fun stuff. I'll tell you what, I love skipping to work every day and waking up and figuring out a new tweet that Trump put out or new information. It's always something that changes my day. Strait of Hormuz crossings, the number of ships passing through remains a real-time geopolitical barometer. Resumption of normal traffic signals and de-escalation and oil market stability. We're getting some, hopefully, resolution. We'll see how things go. But as things are looking peachy. This could be something that lasts much, much longer. But again, we've looked at the data on previous wars and where that went. Highly, highly doubt that will affect anything in the long term. Inflation data. Headline CPI was expected to jump from 2.4 to 3.4%. Whether this is a one-time spike or an upward trend will shape the Fed's next move significantly. Especially with the new Fed chair coming in, we're keeping a close eye on where that's going to go and how that policy will be shaped. Rate decisions and balance sheet management will be pivotal. Lower rates over time support both equity valuations and housing market activity. Consumer confidence recovery, one of the most important leading indicators right now. A sustained recovery here has historically preceded strong equity market performance. S&P 500 earnings revisions, estimates at $320 for 2026 and $372 for 2027. Continued upward revisions confirming the fundamental health of corporate America through this uncertainty. Look at the balance sheets, ladies and gentlemen. Look at the balance sheets. Mm-hmm. Something else I want to touch on real quick, CapEx expenditure of the major AI hyperscalers. If you were a buyer of software or the Mag 7 in 2025, you were quite happy. Although if you were a buyer in software in 2026, you don't have to tell me. You might need to go to confession for that, but it was something you didn't want to be in. But keeping an eye on CapEx expenditure on these AI infrastructure, you're seeing a big AI race, bunch of buying on. They're going to be using their revenues to build out their infrastructure. So a percentage of their operating, bigger percentage of their operating cash flow is going up and up towards this hyperscaling. We'll see where they are. I'm keeping a track on their revenues just because this is important because of their weighting in the S&P 500. So keeping an eye on what their free cash flow is being designated for and where what return on investment is going to be expected from it. And the actual expected return on investment is really, really important for these guys. So keeping an eye on capital spending and where that money is going at the end of the day is something we're keeping track of. Long-term tailwinds. So the bigger picture, as Noel said, American manufacturing is reshoring. We like it or not, some of the things Trump put in place have forced people's hands and are now putting orders into the U.S. So we're seeing a lot of U.S. factories with full book orders and trying to keep up with everything that's going on. This is a multi-year structural shift and not just a one-time thing. We are hoping. Housing demographics. The largest segment of the population, ages 33 to 35, are first-time home buyers. This creates a 5 to 7 year tailwind for housing, furniture, and consumer spending. We're seeing a lot more sellers in the market than buyers, and people those ages are hopping on that trend. AI infrastructure build out. We all know how cool AI is and how impactful it will be, but things need to be put in place before that becomes a reality rather than a dream. Data center power demand is going parabolic. We are making plays in that and looking at how to allocate for that. But the picks and shovels of the AI revolution are going to be power, semiconductors, infrastructure that represent long-term durable growth. A lot of people were looking at, Noel, do you remember Ask Jeeves?
Yeah. Oh.
Yeah, Ask Jeeves. Yeah,
I haven't seen that in years.
Those who remember Ask Jeeves were thinking, Yahoo, Ask Jeeves were expected to be the biggest internet players in the space, right? But then a small company like Google came out of nowhere and took a lot of that market share.
About all of it.
Yep, exactly. So what I'm saying by that story is, while people are investing in these AI companies, we are just in the tip of where this is going. If you are playing the game on where you think that company is going to be in the future, I hate to say it, but you're playing a game that would resemble a lot of the internet boom. And we all know what happened during that time, right?
It's sort of like investing in pet rocks.
That was fantastic. I read a little bit about that story in college, and I thought there's no way that was real.
But people were investing in it. It was going to be a big thing.
It was a funny story. Talk about interesting consumer behavior. That was something that was really interesting to me. But yeah, at the end of the day, we don't care about who we're betting on in the AI arms race. We care about the arms dealers. And when we say arms dealing, we are talking power, semiconductors, and infrastructure. That's always going to be there. I don't want to bet on what company is going to win that race. I want to bet on the people that are providing that supply, because that is going to be the long-term growth, not the fight that we're seeing in the bullpen on whoever is putting in as much money and who's going to rise to the top. That's going to be great. I'm sure whoever guesses that right is going to make a lot of money, but that's not that's gambling, not investing. Not worried about that. I'm looking at things that will produce over time, almost way more probabilistically than what that would be. So that's what we're looking at. We're keeping an eye on the dollar weakening trend, especially with a couple of plays and a couple of our models. We're looking at international investing. If a declining dollar benefits institutional earnings, or I'm sorry, a declining dollar benefits international earnings when converted to USD, adding a meaningful tailwind for companies with global revenue exposure in coming years. So it's a lot
in past years, Gabe, has been that if you invested internationally, you were falling behind the people that invested in the U.S. only. But that has changed in the last year or so. And people that are investing internationally are actually doing better than the people who invest exclusively in the U.S.
It's the importance of diversification, right? And this trend that we're seeing with the dollar, we're keeping an eye on it and we're making plays from it. But it's always good if this turns into something that comes to fruition. We're into companies that also have exposure with their revenues elsewhere. You know, if a company is getting half of their revenue from the US and half of their revenue from, let's say, Europe, Asia, that's fantastic. You know, if the dollar is strengthening, you're getting that money tailwind from there. If the dollar is weakening, you're getting that tailwind from Europe and Asia, where the currencies are doing much better compared to us. So the declining dollar is the current trend that we're seeing. Our international plays and our international exposure will come to fruition and will come back with great bags of happiness. I skipped too far. Key takeaways from this, y'all. I don't want to take up too much of your time. I love doing this. I'd love to hear your guys' thoughts if you'd like to have a longer show with more data. There's tons of stuff I could add on to this and tons of stuff I would love to talk about more. But I don't want y'all to fall asleep. Just want to give you the fun information on what's going on. But key takeaways, the sell-off was driven by fear and geopolitical concerns, not by deteriorating economic fundamentals. The underlying economy remained healthy throughout the decline. Sentiment reached historic extremes. The put-call ratio, the fear-greed index, and insider buying all pointed to a rare buying opportunity, not a market breakdown. Earnings estimates for the S&P 500 kept rising even through the conflict. Corporate America entered with its strong fundamentals, and those fundamentals held. The recovery has began. Seasonal patterns and the resolution of geopolitical uncertainty support the case for continued strength, with some expected volatility around the October election. Long-term tailwinds, reshoring of manufacturing, housing demographics, AI infrastructure remain fully intact. Short-term noise does not change our bigger picture. Fun little things we got to discuss today. Really good information, really good data, tons of stuff more that I could add to this, but that would take over an hour and a half, and I don't want to take up too much of your time, but we're coming in on about 40 minutes, and I want to keep this a little short. With that being said, if you would like to see us do this longer, if you'd like to see us do it shorter, we'd love to hear from you. I want to make sure that you guys are getting as much valuable information from us as possible. And so letting us know if you have a certain question on specifics that we'd covered, specifics that we didn't cover, we'd love to hear from you. Ask a question, shoot me an email. Let me know that this is a question for the ProVest Pulse, and I will add you to that list. But besides that, Noel, anything you want to add on?
No, I just think that that we have started doing these videos, and I think that they give people that are our clients, it gives them an idea of what we're thinking, how we're going about it. We're doing these on a regular basis. This is our second one, but we'll be doing these on a regular basis from here on out. And we do want to hear from you. We want you to interact with us on these. If you like what you're seeing, if you think that it's meaningful to you, let us know. If there are comments that you want to make about something, if we said something that wasn't quite clear enough, if we need to say, define certain words for you, like, I don't know, off the top of my head, I heard Gabe talk about CapEx. We might need to define that for you. If so, let us know. We don't mind. We don't want to talk down to anybody and say, well, we've got to keep everything at an elementary level, but we want you to understand everything that we're talking about. Listen, we really appreciate you coming on with us. We appreciate you taking a look at this. And And please pass this on to people that you think could use the information that we imparted to you here.
Yep. And I'm thinking currently this video is going out to current clients of ProVest, so we keep this away from the general public. That being said, we might open this up later on if a lot of people do get value from it. If you think people would enjoy this, we might open this up to the public, but this is specifically for ProVest clients that would benefit from this information and give you an insight on what we're doing. We love to be transparent. I love to give thoughts on what's going on and just share the data that is influencing a lot of our decisions here and what we're looking at. But I digress. Send us an email if you'd like to talk to us. Give us a call if you want to hear our voices other than this YouTube.
And let us know if you do believe that this presentation is about right, or if it's too long, or if you want more information, if you want it to be a little longer. You know, I know that sometimes people look at something and they say, oh, it's going to be 40 minutes. I don't have time to watch it. Well, let's just say, would you watch it if it was 10 minutes? And so we can take this information and we can concentrate it. You won't get all the richness of all the information, but we can make it shorter for people who have less time to look at it over a longer period. You don't have 40 minutes. You don't have 60 minutes to watch it.
Absolutely. Well, Noel, it's been great. One last thing for everybody that's watching. Do me a favor and pause your video now to go over this disclosure. This was for informational purpose and does not constitute investment advice. Consult your local psychic or your crystal ball, or if you like to call it your financial advisor, feel free for that.
Absolutely. You got to read every word of this because there will be a test.
We'll get to that test eventually. It'll be a surprise test. Anyways, y'all, it's been great talking to you. Bye for now.